JPMorgan pressing pause on Netflix, the firm downgrading the streaming giant to neutral from overweight, while still positive on the stock long-term. Analysts saying, quote, the risk-reward near-term is becoming more balanced after its recent run. The firm did, though, raise its price target by $70 to $1,220. Netflix shares have nearly doubled in the past year. So just because it's run so far so fast.
Very reasonable. Yeah. I mean, they're overweight, they go to neutral, still have a $1,220, what is it, $1,220 price target, good for them. I mean, this is what the analyst community should be doing this. I admire the call and I understand it. You know, valuation, the market, all those different things. But with all that said, I don't think you really run all that far away from Netflix. I mean, every sell-off of the last couple of years has been tremendous opportunity. They continue to dominate the space.
Yeah, I mean, not that much impact to the stock's action today.
No, and it was proven safe in a terrible, volatile market, and I think it's been proven safe even before that. And it's just, what are we going to pay? What's the multiple we're going to put on this? There are drivers. There's certainly the ad tier support, but there are the events dynamics. There's the international expansion. I mean, there's a lot of things that can give you a sense. The economies of scale are really helping here, and I think the margin stays high.
One point that's interesting, though, is that Netflix is seen as sort of a secure place, safety from tariffs, basically. Not impacted by tariffs at all. And so to the extent that tariff pressure comes off the name, comes off the markets, should Netflix give back some of that?
That's a good point. But I also think people think of it as in a recession is the last thing you're going to get rid of, right? Or you may do the ad-supported tier. Mm-hmm. So I'm long Netflix. I read the report. I think they make very good points. It's hard to really, I can't really say there's a value investment here. However, so I sold some July 1200s. Every time I have done this trade, you'd think I would learn something, but I haven't because I sold. They're $70, right? It seems like, well, that's a lot of premium. We'll see. I don't know. That's been I've been wrong several times selling those, and I had to buy them back higher.
Part of the thesis, to your point on the downgrade, was that people will move out of less defensive stocks and become much more aggressive. This is actually a growth company. And they've had 2 or 3 different times in the last few years where people have doubted, oh, you're going to cut off passwords? Well, that's going to hurt your subs. Nope, didn't happen. Oh, you're going to go spend a lot on live sports? Yeah, it was accretive, or will turn out to be accretive. Or all these transformational things that they've done. You're going to stop giving quarterly subscriber growth? We're going to punish you for the lack of optics. Well, guess what? They blew away those numbers again. So to me, yes, it's expensive. But as I said on JPMorgan, people are going to pay a premium in various sectors. It's a $500 billion company. You can't not be there as a fund manager if you think there's growth in the company.